The petrodollar system is not collapsing in one dramatic explosion. It is breaking quietly, one oil deal at a time, one alliance at a time, one currency decision at a time, one household budget at a time. A few hours ago, Andrei Jikh released a major breakdown on what he called the end of the petrodollar. He focused on the United Arab Emirates leaving OPEC, the rise of China's influence, the pressure on US debt, and why the dollar's role in global energy markets may be entering a dangerous new phase. That analysis matters. But this episode is about the part most global finance videos do not show. What does the weakening of the petrodollar mean for ordinary people? What does it mean for gas prices, for groceries, for rent, for electricity, for insurance, for the $100,000 salary that used to feel successful but now barely feels stable in cities like San Diego? Welcome back to Broken Economy. Today, we are looking at the street-level consequences of the petrodollar shock, because from Wall Street, this looks like geopolitics. From Washington, it looks like energy strategy. From Beijing, Abu Dhabi, and Riyadh, it looks like a power shift. But from the road, it looks like higher prices, weaker savings, and a middle class being squeezed from every direction. The first thing to understand is this: the petrodollar was never just about oil. It was about demand for the dollar. For decades, global energy markets created a powerful reason for countries around the world to hold dollars. If you needed oil, you needed access to dollar-based trade. If oil exporters earned dollars, many of those dollars flowed back into US financial markets. They bought treasury bonds. They held dollar assets. They helped finance American deficits. They helped support the global status of the US dollar. That system gave America an enormous advantage. America could borrow more, spend more, run larger deficits, export inflation more easily, and still remain at the center of the global financial system. That was the privilege. But privileges do not disappear all at once. They fade. And when they fade, ordinary people usually feel the impact before the official language changes. That is what makes the UAE's OPEC exit so important. This is not just one country changing oil policy. It is a signal that the old energy order is becoming less stable. The UAE wants more flexibility, more production control, more strategic independence, more room to deal with different global powers. And when a major Gulf energy player starts moving away from the old cartel structure, the message is clear. The system that looked permanent is becoming negotiable. That does not mean the dollar disappears tomorrow. That does not mean the United States collapses next week. That does not mean every oil trade suddenly moves into yuan. But it does mean something serious. The old assumption that the dollar automatically sits at the center of every energy transaction is becoming weaker. And when that assumption weakens, the cost of maintaining the American financial machine goes up. This is where Andrei's video becomes important, because he is talking about the global layer. But the broken economy is about what happens after the global layer hits your monthly bills. If the dollar loses some of its energy dominance, America may have to fight harder to attract global capital. That can mean higher interest rates, higher debt service costs, more pressure on the federal budget, more inflation risk, more currency volatility, and more pressure on households. That is the chain most people miss. A country changes oil policy overseas, bond markets react, energy markets adjust, currency risk rises, interest rates stay higher, gasoline gets more expensive, shipping gets more expensive, groceries get more expensive, insurance gets more expensive, and then somebody in Southern California wonders why a six-figure salary no longer feels like success. That is the petrodollar shock at street level. It does not arrive as a headline saying your life is about to become harder. It arrives as a gas receipt, a grocery bill, an electric bill, a rent renewal, a higher car insurance premium, a credit card balance that does not go down. This is why the $100,000 salary has become one of the clearest symbols of the broken economy. For decades, $100,000 meant you made it. It meant stability. It meant middle-class comfort. It meant choices. But in many American cities, that number has been hollowed out. Taxes take the first piece. Rent or mortgage takes the second. Insurance takes the third. Transportation takes the fourth. Food takes the fifth. Utilities take the sixth. Debt payments take whatever is left. And by the end of the month, the number that looked powerful on paper feels weak in real life. That is not a personal failure. That is a currency problem. That is an energy problem. That is a debt problem. That is a global power problem, showing up inside a household budget. The second thing to understand is that oil is not just gasoline. Oil is the hidden input behind modern life. It moves trucks. It moves ships. It moves airplanes. It powers logistics. It affects fertilizer. It affects plastics. It affects packaging. It affects construction. It affects food distribution. It affects almost every physical supply chain. So when oil markets become unstable, the pressure does not stay at the gas pump. It spreads. A higher diesel price becomes a higher delivery cost. A higher delivery cost becomes a higher grocery price. A higher grocery price becomes a weaker household budget. A weaker household budget becomes more credit card debt. More credit card debt becomes more interest payments. More interest payments become less saving. Less saving becomes more dependence on the system. That is the loop. And this is why the end of petrodollar dominance, even if it happens slowly, matters so much. Because if energy becomes more expensive in dollar terms, ordinary Americans do not just pay once. They pay everywhere. They pay at the pump. They pay at the supermarket. They pay in rent. They pay in utilities. They pay in insurance. They pay in the price of almost every physical good. Wall Street may call this macro adjustment. Households call it survival getting more expensive. The third layer is US debt. This is where the story becomes much bigger than oil. The United States does not just need the dollar to be strong because of pride. It needs the dollar to be strong because the country depends on buyers for its debt. Treasury markets are the foundation of the American financial system. If global demand for US debt weakens, interest rates can become harder to control. If interest rates stay high, the government pays more to service debt. If the government pays more to service debt, deficits get worse. If deficits get worse, the Treasury has to borrow more. If the Treasury borrows more, the system needs even more buyers. That is the debt loop. And if the old petrodollar recycling system weakens, that loop becomes more fragile. This does not mean foreign countries dump every US asset overnight. That is not how systems usually break. Systems break through pressure, through reduced trust, through slower demand, through diversification, through countries quietly choosing to hold more gold, more non-dollar reserves, more strategic commodities, more bilateral trade agreements, more alternatives. The danger is not that the dollar disappears. The danger is that the dollar becomes more expensive to defend. And when a currency becomes more expensive to defend, households usually pay. They pay through higher rates. They pay through inflation. They pay through lower purchasing power. They pay through weaker job markets. They pay through lower living standards. That is the real transfer. The fourth layer is China. Andrei's video points toward a reality that is becoming harder to ignore. China has spent years building influence across energy, commodities, infrastructure, and strategic supply chains, rare earths, refining, manufacturing, ports, trade relationships, energy deals, payment systems. This does not mean China has already replaced the United States. It has not. The dollar is still dominant. US capital markets are still massive. American military power is still enormous. But global power does not shift. Only when one empire disappears and another instantly replaces it. It shifts when other countries gain options. That is what is happening now. The UAE wants options. Saudi Arabia wants options. China wants options. Global South countries want options. Central banks want options. Energy producers want options. And every new option slightly reduces the old automatic demand for the dollar. That is the real story. Not the sudden death of the dollar, the gradual loss of monopoly. And monopolies are extremely profitable until they are no longer monopolies. The United States built its standard of living on a system where the world needed dollars. If the world needs fewer dollars over time, America has to compete harder. That competition shows up as pressure on interest rates, on deficits, on energy costs, on household budgets, on the middle class. This brings us to gold. One of the clearest signs that trust is shifting is the behavior of central banks. When central banks buy gold, they are not buying a meme. They are buying insurance. Insurance against currency risk. Insurance against sanctions risk. Insurance against debt risk. Insurance against a world where the old reserve system becomes less predictable. Gold does not produce cash flow. It does not innovate. It does not hire workers. It does not build AI models. But it does one thing very well. It sits outside someone else's liability. That matters in a world where trust is being repriced. For decades, US Treasuries were treated as the safest asset in the world. But if more countries begin to question the long-term purchasing power of the dollar, gold becomes more attractive. Not because gold is magic, but because debt requires trust. And when trust weakens, hard assets become more interesting. This is why the Petrodollar story connects directly to the market story. If the world becomes less willing to absorb US debt at low rates, then the old American model becomes harder to sustain. Cheap capital becomes less cheap. Deficits become more painful. Asset valuations become more vulnerable. The cost of living becomes harder to control. And the ordinary worker gets squeezed again. Now look at the street-level reality. Imagine driving through a city where the stock market is still near record highs. The tech sector still looks powerful. AI companies are raising billions. Defense contractors are signing new contracts. Energy companies are repositioning. Central banks are buying gold. Gulf states are rewriting alliances. China is making new deals. And ordinary people are standing at a gas pump, wondering why half a tank feels like a luxury purchase. That is the great disconnection. The global system is reorganizing, but households are being told to just budget better. They say cancel subscriptions, cook at home, work harder, invest earlier. But the problem is deeper than personal finance. You cannot budget your way out of a currency regime shift. You cannot side hustle your way out of energy inflation. You cannot coupon your way out of a debt-based system losing its global subsidy. That does not mean people should give up. It means people need to understand what they are actually facing. Because if you think the problem is just your spending habits, you will blame yourself. But if you see the structure, you start asking better questions. Why is energy more expensive? Why is debt harder to service? Why does a strong dollar still feel weak at the grocery store? Why are central banks buying gold? Why are energy exporters seeking more flexibility? Why does America need so much borrowing just to maintain normal life? Those are the questions that matter. This is also why the old American dream feels different now. The old dream assumed the dollar would hold value. It assumed wages would gradually rise. It assumed homes would be affordable. It assumed energy would be abundant. It assumed global trade would support lower prices. It assumed the United States would remain the unquestioned center of the financial world. But if those assumptions weaken, the dream becomes more expensive to maintain. A house costs more. A car costs more. Insurance costs more. Food costs more. Electricity costs more. Debt costs more. And suddenly, ordinary life becomes a premium product. This is the final stage of the petrodollar story that most people do not see. It is not just about whether oil is priced in dollars. It is about whether the American household can continue to live under the benefits of a system built decades ago. If that system loses strength, the adjustment does not happen evenly. The wealthy adjust through assets. The government adjusts through debt. Corporations adjust through pricing power. But ordinary people adjust through sacrifice. They drive less. They save less. They eat out less. They delay children. They delay home ownership. They use more credit. They work more hours. They accept less security. That is how global power shifts enter private life. Not through speeches, through bills, through trade-offs, through the quiet shrinking of what a paycheck can buy. So when Andrei Jikh talks about the end of the petrodollar, the question is not only whether the dollar loses reserve status tomorrow. That is too simple. The real question is this: how much more expensive does American life become as the dollar loses pieces of its old privilege? That is the question behind the $100,000 poverty line. Because if $100,000 no longer buys stability, then the issue is not just income, it is the entire cost structure of the country. Energy, housing, healthcare, insurance, debt, taxes, and the currency itself. This is why the UAE leaving OPEC matters. Not because one headline changes everything, but because it is part of a pattern. Energy producers want more independence. China is building more influence. Central banks are diversifying. Gold is becoming more important. US debt is becoming harder to ignore. And ordinary people are absorbing the pressure through higher costs. The petrodollar is not a switch that turns off. It is a foundation that cracks slowly. And when a foundation cracks, the people living on top of it feel the shaking first. Go to the comments and tell us what you are seeing in your city. Are gas prices changing how people drive? Are grocery bills getting worse? Are restaurants getting quieter? Are people using credit cards just to survive? Does a $100,000 salary still feel successful where you live? Andrei Jikh explained the global petrodollar shock. Broken economy is showing what that shock does to ordinary life. Because the end of the petrodollar is not just a story about oil. It is a story about your paycheck, your savings, your rent, your energy bill, and the shrinking value of the money you work so hard to earn. Subscribe to Broken Economy for more clear breakdowns of finance, technology, and the real economy behind everyday life. Stay awake. The dollar system is changing, and the street will feel it before the headlines admit it.